Hello, everyone. My name is Yaman, and I provide daily updates on Tesla, markets, and technology. Let's get started. Markets are mixed today. Dow Jones is flat. Nasdaq is down 0.5%. S&P 500 down 0.3%. Russell 2000 up 0.3%. Oil prices are down $1 barrel to $65. Yield curve has flattened a little bit. The shorter end is higher slightly, longer end is lower slightly. Heat map shows Nvidia down 1.6%, Amazon up 1.5%, healthcare is up a little bit, financials are down, industrials are generally down. We're going to start with Tesla news today. Let me know if the audio quality is good or if I need to do anything. Tesla, this is a Fred Lambert article. Tesla withheld data, lied, and misdirected police and plaintiffs to avoid blame in autopilot crash. This is an incredible article. I highly recommend going and reading on your own as well. But I'm going to read a few paragraphs first. Tesla was caught withholding data, lying about it, and misdirecting authorities in the wrongful death case involving autopilot that it lost this week. The automaker was undeniably covering up for autopilot. Last week, a jury found Tesla partially liable for a wrongful death involving a crash on autopilot. Fred explained the case and the verdict in another article. But we now have access to the trial transcripts, which confirm that Tesla was extremely misleading in its attempt to place all the blame on the driver. The company went as far as to actively withhold critical evidence that explained autopilot's performance around the crash. Tesla withheld the crash snapshot data that its own server received within minutes of the collision. Within about 3 minutes of the crash, the Model S uploaded to a collision snapshot video, CAN bus streams, EDR data, etc. to Tesla's servers, the mothership, and received an acknowledgement. The vehicle then deleted its legal copy, resulting in Tesla being the only entity having access. What ensued were years of battle to get Tesla to acknowledge that this collision snapshot exists and is relevant to the case. The police repeatedly attempted to obtain the data from the collision snapshot, but Tesla led the authorities and the plaintiffs on a lengthy journey of deception and misdirection that spanned years. And then the article goes on to the detail of what happened. April 2019, the crash and the instant upload of Tesla pretended never happened. In May 2019, Tesla's lawyer scripts the homicide investigator's evidence request, which is incredible. In June 2019, a staged cooperation that corrupts evidence. And this is, Fred has receipts all going back to the lawsuit documents. 2019 through 2024, for 5 years, repeated denials and discovery stonewalling by Tesla. The facts are Tesla had the data on the servers within minutes of crash. When the police sought the data, Tesla redirected them toward other data. When the police sought Tesla's help in extracting it from the computer, Tesla falsely claimed it was corrupted. Tesla invented an auto-delete feature that didn't exist to try explain why it couldn't originally find the data in the computer. When the plaintiffs asked for the data, Tesla said that it didn't exist. Tesla only admitted to the existence of the data once presented with forensic evidence that it was created and transferred to its service. And in late 2024, court orders a bit-for-bit NAND flash image. And then earlier this year, the forensic treasure trove reveals the file name and checksum. So, and then subpoenas involved server logs to get Tesla to actually do what's right to do. I mean, we have a family trying to figure out what happened to their daughter, and Tesla is holding back information, according to this article. I highly recommend reading the article in full. We're not going to go through it, every single sentence here. But there's more on Tesla front. Tesla Elon Musk sued by shareholders over robotaxi claims. Elon Musk and Tesla were sued by shareholders who accused them of securities fraud for concealing the significant risk that the company's self-driving vehicles, including the robotaxi, were dangerous. The proposed class action was filed on Monday night following Tesla's first public test of its robotaxis in late June in the company's Austin, Texas hometown. That test showed the vehicle speeding, braking suddenly, driving over a curb, entering the wrong lane, and dropping off passengers in the middle of multi-lane roads. Musk and his electric vehicle maker were accused of repeatedly overstating the effectiveness of and prospects for their autonomous driving technology, inflating Tesla's financial prospects and stock price. Shareholders said this included Musk's assurance on April 22 conference call that Tesla was laser focused on bringing robotaxi to Austin in June, and Tesla's claim the same day that its approach to autonomous driving would deliver scalable and safe deployment across diverse geographies and use cases. Tesla did not immediately respond to on Tuesday to requests for comment. CFO said and his predecessor are also defendants. Wow. Expanding robotaxis is crucial for Tesla as the company faces falling demand for its aging EV and a backlash over Musk's politics. Musk, the world's richest person, wants to offer the service to half the US population by year end. Not going to happen. But Musk convinced regulators and assured the public his technology is safe. Give me 1 second. Monday's lawsuit in Austin federal court is led by Tesla shareholder Denise Moran and seeks damages for shareholders between April 19, 2023 and June 22, 2025. A Florida jury on August 1 found Tesla 33% responsible for a 2019 crash involving its self-driving software, which killed a 22-year-old woman and injured her boyfriend, and ordered it to pay $243 million in damages to victims. Tesla blamed the driver and plans to appeal. On top of that, Tesla sales keep slumping in Europe with BYD gaining ground. Tesla sales in Europe continue to decline with significant market share ceded to China's BYD. In Germany and the UK, those are the two biggest markets, Tesla's July sales fell by over half compared to the previous year, while BYD's registrations quadrupled. And my understanding is that BYD delivers just as many, if not more, pure EVs than Tesla does across Europe. And then on top of that, that this article doesn't discuss is that Xiaomi, which is bringing U7 to China this year, and I think in 2 years to other markets, including Europe, that's not even including these numbers. So I think it's only going to get worse for Tesla in Europe, China, and everywhere else except for US, I guess, because the United States government protects Tesla, both Biden and Trump administrations. Now, in the US, however, there's new EVs proliferating as well. The Chevy Equinox EV crushed it in July, the best sales month ever for a non-Tesla EV. Let's read the summary on this one only because we have a lot to discuss today. The Chevy Equinox had its best sales month ever in July, with over 8,500 units sold, making it the best-selling non-Tesla EV in the US. This surge in sales, driven by the affordable LT model, contributed to a 115% increase in GM's EV sales compared to the previous year. The Equinox EV's success is attributed to its attractive design, driving range, fast charging capabilities, and competitive price point. I mean, this is very impressive, but what I'm about to read next is pretty stunning. And we've discussed EREVs before in this podcast. And this is one example of why EREVs, I think, are the future. On August 1, IAM Motors, the premium new energy vehicle brand co-backed by SAIC, Alibaba Group, officially launched its new super range extended technology, Hengxing, literally named Star, marking its entry into the growing range extended electric vehicle segment, so EREVs. 2 upcoming models will debut with the new technology. According to IAM Motors, the Hengxing technology represents a major technological integration from its parent company, SAIC, delivering a new category of new energy vehicles capable of over 1,500 kilometers of combined range. 1,500 kilometers, over 1,500 kilometers of combined range. So that's about 1,000 miles. Okay. Now, I think the China's range standard is a little bit more forgiving than the EPA, but even convert the EPA, it's more than 600 miles of combined range, and 400 kilometers, so about 300 miles, coming from the battery power alone. Okay, There's a lot more in the article, but that's what I want to highlight. And it's a good looking vehicle, as you can see here in this picture. Good looking vehicle. Um, Anywhere from 600 to 1,000 miles of combined range on one charge. And I think this vehicle has 800-volt electrical architecture. There you go. 800-volt high voltage battery pack dedicated to revs. It offers a battery power range of up to 450 kilometers under the CLTC test cycle, enough to cover a week's worth of city driving. And now here's another kicker that no Tesla can match this today. The 800-volt architecture sports an ultra-fast charging at a peak power of 268 kilowatts, enabling a 310-kilometer range top-up in just 15 minutes. So that's more than 200 miles in 15 minutes. Okay. Now let's switch to overall market news. We're going to dig into the ISM report today, ISM service report that I thought has some stagflation hints at it. It's more than a hint. U.S. services activity flatlined in July, ISM data shows. U.S. services sector unexpectedly flatlined in July with little change in orders and a further weakening in employment, even as input costs climbed by the most in nearly 3 years, underscoring the ongoing drag of uncertainty over the Trump administration's tariff policy on businesses. We're actually going to dig into the report today, okay? Because I think there's a lot of good data here that is kind of missed in the headlines. Business activity index 52.6, new orders index at 50.3, barely expansion, basically just stagflation. Employment index at 46.4, so less than the 50. So employment is contracting in the services sector, or contracted in the services sector in July. Okay. We just got the July employment numbers, and they were greater than zero. But ISM services index, which is basically 80-90% of the economy, shows contraction on the employment side. So I suspect the NFP is going to get revised down next month as well, non-farm payrolls. And the supply deliveries index at 51%. Economic activity in the services sector grew in July for the second consecutive month, say the nation's purchasing and supply executives in the latest services ISM report on business. The services PMI indicated expansion at 50, but barely expansion, above the 50% break-even point. The report was issued today by Steve Miller. Quote, in July, the services PMI registered 50.1%. This is repetitive. Business activity index remained expansion in July, registering 52.6%. The index has not been in contraction territory since May 2020, according to business activity index. New orders index also remained in expansion territory in July, according to a reading of 50.3%, a drop of 1 percentage point from the June figure. The employment index was in contraction territory for the second month in a row and the fourth time in the last 5 months. Okay. So this, those who have been paying attention to detail on the employment front were not surprised that the non-farm payroll figures were drastically revised downward. The May-June combined revision downward was highest, I think, in decades. And if you were paying attention to the detail like this one, you weren't surprised. I'm going to read that part again. The employment index was in contraction territory for the second month in a row. So this is June, July, and the fourth time in the last 5 months. The reading of 46.4% is 0.8 percentage point lower than the 47.2% recorded in June. So it's getting worse. The supplier deliveries index registered 51%. This is the 8th consecutive month that the index has been in expansion territory, indicating slower supplier delivery performance. The price index, this is the part that I think people are really ignoring that they should be paying attention to. The prices index registered 69.9% in July, a 2.4 percentage point increase from June's reading of 67.5%. The index has exceeded 60% for 8 straight months, with July's reading the highest since October 2022, which is when it was 70.7%. And I think it can increase again in August. I think this is the impact of tariffs. And it kind of puts into question the rhetoric that tariffs will only impact imported goods. So I'm not sure if that's necessarily true, given that this prices paid index is so high. The inventories index was expansion territory in July for a second month in a row, registering 51.8%, a decrease of 0.9 percentage point from June's figure of 52.7%. The inventory sentiment index expanded for the 27th consecutive month. The backlog of orders index was in contraction territory for the fifth month in a row, registering 44.3%. 11 industries reported growth in July, one more than June. The services PMI has expanded in 58 of the last 62 months, dating back to June 2020. Miller continues, July's PMI level continues to reflect slow growth, and survey respondents indicated that seasonal and weather factors had negative impacts on business. The employment index's continued contraction and faster expansion of the prices index are worrisome developments. I mean, this sentence right here just spells out stagflation. New exports and imports indices, which both moved from expansion to contraction, provided signals that tariff tensions are impacting global trade. However, continued expansion in the business activity and new orders indices, together with a slight improvement in the backlog of orders index, highlight the resilience of the U.S. services sector. Some respondents noted increased transportation congestion that supported the slower supplier deliveries index reading. Another sign that activity levels are expanding. The most common topic among survey panelists remained tariff-related impacts. This is another key sentence. The most common topic among survey panelists remained tariff-related impacts, with a noticeable increase in commodities listed as up in price. Okay. Let's read some anecdotal evidence from the respondents. Anticipation of the final tariff impact is resulting in delayed planning for next fiscal year purchases. Higher tariffs are increasing the cost of imported feed ingredients and trace minerals for livestock and poultry feeds. Business and customer concerns over additional cost risk due to additional tariffs. Trade uncertainty causing client reevaluation of feasibility for projects in certain sectors, resulting in some delays or cancellations. Public funded jobs experiencing pullbacks in construction. Summer break for students greatly reduces demand on campus educational services. Steady business activity, finance, and insurance. I think that's in part due to the rising stock market. If the stock market were to decline, I think you're going to see finance and insurance sentiment drop as well. Tariffs are causing additional costs as we continue to purchase equipment and supplies. Though we need to continue these purchases, the cost is significant enough that we are postponing other projects to accommodate these cost changes in healthcare and social assistance. Extra purchasing to head off tariffs has leveled off, expecting decrease in activity in the second half of 2025. Mining. Economic uncertainty remains a dominant theme. However, the tariff talk has turned out to be much more bluster than actual policy, and businesses have seemed to tune out the noise. The outlook continues to look incrementally positive according to real estate, rental, and leasing. Retail results are solid, a little soft before and during 4th of July week, but then a rebound. We see no reason to believe that this won't continue for near-term retail trade. Our business activity is flat. We're not trending up or down. Tariffs are now starting to show up in pricing, and we are seeing increases across the board. So this is a critical part, I think. Tariffs are now starting to show up in pricing because tariffs really came about, as you know, in April, May, but companies had lots of inventory on stock for 2 to 3 months. So if you count from April, May to 2 to 3 months, you're looking at July. And next week, we're going to get CPI numbers and PPI numbers on inflation. So it's going to be interesting to see the tariff impact finally starting to show up in these inflation reports. Okay, lots more detail. You can read about it on your own, pause the video, whatever, or go to there's a lot of detail on these reports. Okay. All right, let's move on. Trump gets tariffs, Americans get price hikes. US President Trump is getting his tariffs. Companies are making clear how they intend to deal with it, passing them on to the American consumers. Throughout the spring, big retailers and consumer product makers warned that levies on imported goods would squeeze their operations, forcing them to choose between lower earnings and passing on higher costs to customers. In the case of Procter& Gamble and others, it is both of those things. On Tuesday, the packaging giant, which makes household basics spanning from Bounty paper towel to Tide detergent, issued a sour outlook for 2025 and sent a message to big retailers like Walmart that it will have to raise prices on some US goods from next week. This challenge facing companies in the coming quarters will likely feed through to everyday consumers. P&G said it would raise prices on about a quarter of its products in the US to help offset the cost of new tariffs. Price hikes are in the mid single digits across categories, a spokesperson for the company said. Wow. Price hikes are in the mid single digits across categories. That is massive. While the US stock indices have soared, by the way, this is saying from next week. So in August, it's going to get reflected. So as you can see, the tariff impact on inflation numbers is going to permeate in an S curve shape, I think. So the crux of it is, I think, in Q3 and then Q4. While US stock indices have soared to record highs this year, built on massive investment in technology shares, many consumer bellwethers have struggled. Since Trump's April 2 Liberation Day tariff announcements, P&G shares have declined 19%. Nestle is down 20%. Kimberly-Clark has lost 11%, and Pepsi is off nearly 7%, while the benchmark S&P 500 stock index has gained more than 13%. Consumer goods, food, and drink companies have struggled with lackluster sales since the pandemic, as shoppers have balked at increasingly expensive name brand packaged food. Nestle said last week that consumers in North America remained wary of paying more at the cash register. More price hikes will deepen investor worries about how big brands are navigating the combined challenge of thrifty consumers and hefty costs created by Trump's trade war. Quote, "You're going to see companies like Walmart, Amazon, and Best Buy forced to pass price increases to consumers," said Bill George, former chairman and CEO of Medtronic and executive education fellow at Harvard Business School. Main Street has yet to see the fallout from increased tariffs, and they're going to go higher. Between July 16 and 25, companies in the Reuters Global Tariff Tracker said they expect to lose a combined $7.1 billion to $8.3 billion for the year. GM and Ford and other car makers have absorbed the cost of tariffs, totaling billions of dollars so far. Many companies shipped more goods and raw materials into the US before tariffs hit. Economists and analysts reckon that hoarding has helped some delay hiking prices until later in the year and explains why tariffs have not yet shown up in US inflation data. Andrew Wilson, International Chamber of Commerce Deputy Secretary General, estimates inflation will be felt once companies have run down inventory, but that might not be until the fourth quarter or first quarter of next year. Swiss watch and jewelry maker Swatch increased prices by about 5% after Trump announced tariffs in April with zero impact on sales, CEO Nick Hayek told Reuters recently. High-end brands like Tissot watches are less price sensitive to increases. Customers wanting to splash out on an expensive watch might also buy abroad when traveling where taxes are lower, he said. You cannot do this with cars. You cannot do this with machines, but you can do this with watches. So it's not so problematic for us, he said. Okay. So, like I said, next week is the inflation reports. Starbucks under pressure again as Brazilian tariffs hike coffee costs. Starbucks may soon have to hike price on its pumpkin spice lattes and bottled frappuccinos. I don't buy either, so I'm good. The coffee giant is facing cost pressure from the 50% tariff on Brazilian coffee imports, which takes effect on August 6th. Brazil is the largest coffee exporter to the US. Okay, so here we go again. So 50% tariff on Brazilian coffee imports takes effect on August 6th. Okay, so it's in the future to come. Tariffs will increase Starbucks' cost of goods, particularly for its ready-to-drink RTD beverages and packaged bean division. Annual costs in the division could increase by 3.5%, resulting in 2 cents earnings per share impact, according to a note by TD Cowen analyst Andrew Charles. The company's margins are already under pressure. In its latest quarter, operating margin fell sharply from 13.3% from 21% a year ago. I think we're going to see this from many companies in the US. I think profit margins are going to decline rapidly, and that will follow the layoffs. Its US same store sales declined for the sixth consecutive quarter. Revenue in the quarter climbed 4%, etc., etc. Let's move on. Man, it's been a long episode. Record surge in past due student loans adds to US debt burden. I think people in their 20s and 30s are really struggling in the US. I think the only group that's really doing okay is the baby boomers, who are also benefiting from rising stock prices as well as high interest rates. So they're getting more interest on their savings. But people in their 20s don't have any savings. And most people in their 30s don't have much savings. So record surge in past due student loans adds to U.S. debt burden. You can see the two graphs on your screens. U.S. household debt 90 plus days late, student debt entering 90 days late. This is even worse than in the early 2000s. Okay. The share of U.S. consumer debt in serious delinquency rose in the second quarter to the highest level since early 2020, reflecting a record surge in past due student loan debt. Some 3% of debt was at least 90 days delinquent in April to June period, up from 2.8% in the first 3 months of the year, the Federal Reserve Bank of New York said Tuesday in its quarterly report on household debt and credit. The share of student loan debt entering serious delinquency was 12.9%, the highest in 21 years of data. The rise in delinquencies suggests American households are facing increasing financial distress this year amid high interest rates and slowdown in hiring. Recent data showed consumer spending fell in the first 6 months of 2025, even before tariffs started to boost prices. I mean, look at this. Like, this tariff war is coming into already weakening economy. Recent data showed consumer spending fell in the first 6 months of 2025, even before tariffs started to boost prices, which is only now starting to show up. This quarter's flow of household debt into serious delinquency was mixed across debt types, with credit card and auto loans holding steady, student loans continuing to rise, and mortgages edging up slightly. Overall, household debt increased by $185 billion to $18.4 trillion, according to a report, bringing aggregate debt balances 30% higher when they were before the pandemic. For comparison, U.S. gross domestic product has risen 38% over the same period. Alongside the surge is seriously delinquent student loans. Transitions into serious delinquency for mortgages and home equity lines of credit rose slightly, while holding steady for auto loans and declining for credit card debt. Student loan delinquencies have been on the rise since the beginning of the year after the government ended a years-long payment freeze. Still, the share of such debt at least 90 days past due remained a bit below the pre-pandemic levels in the second quarter of 2025. In a briefing with reporters, New York Fed researchers said student loan delinquency would likely continue to rise, eventually returning to pre-pandemic levels between late 2012 and early 2020. The share of student debt was seriously delinquent ranged between 10.7 and 11.8%. Fed officials are paying close attention to the state of consumer as they hold interest rates steady. On Wednesday, Fed Chair Powell told reporters delinquency rates are not a problem, adding that essentially you have a consumer that's in good shape and is spending, though not at a rapid rate. U.S. trade deficit hits nearly 2-year low in June. China gap plunges. Let's read the summary on this one, because otherwise we're going to be here all day. The U.S. trade deficit narrowed in June due to a decrease in consumer goods imports, with the trade gap with China shrinking to its lowest in over 21 years. This decline is attributed to President Trump's sweeping tariffs on imported goods impacting global commerce. The overall trade deficit, including services, reached its lowest since September 2023. We talked about the ISM. Trump tariffs live updates. Trump says pharma tariffs could go to 250%, threatens EU if it fails on investment pledge. President Trump announced plans to impose tariffs on semiconductor and pharmaceutical imports, with pharmaceutical tariff potentially reaching 250%. He also threatened the EU with increased tariffs if it fails to invest $600 billion in the US. Additionally, Trump signed orders to hike tariffs on Canada and several other countries, with the new rates set to take effect this week. So again, it's going to start in early August, and we're not really going to see the effect until months to come. So I think the impact of tariffs on the inflation report is going to rise for the next several months. Pfizer lifts profit view as cuts offset flat sales outlook. Pfizer raised its profit forecast for 2025 due to cost-cutting measures, offsetting a flat sales outlook. The company's stock rose as investors seek positive news following a decline in demand for COVID products. Pfizer is rebuilding post-pandemic, focusing on new medicines and addressing industry challenges like potential tariffs and pricing restrictions. On that note, thank you very much, everybody, and I will chat with you all next time. Take care.